The gas you put in your car this morning, a chunk of it probably came through a waterway 21 miles wide. And as of 2 days ago, Iran just closed it, the Strait of Hormuz, a narrow strip of water between Iran and Oman. At its narrowest point, just 21 miles across. The actual shipping lanes, 2 miles wide. Through this choke point flows 20 million barrels of oil every single day. That's 20% of all oil consumed globally. It's 27% of all maritime petroleum trade on Earth. But it's not just oil. It's liquefied natural gas. It's a third of the world's fertilizer supply. It's the industrial lifeblood of Asia, Europe, and much of the developing world. And now it's effectively shut. You might think there are alternatives, pipelines, other routes. There aren't, not really. Saudi Arabia has an east-west pipeline. The UAE has bypass systems. Combined, they can move about 2.6 million barrels per day. That's barely a tenth of what flows through Hormuz. So when the strait closes, there is no plan B that works at scale. Oil prices just surged over 10%. Brent crude hit a 20-month high. Analysts are warning of $100 to $150 per barrel if this drags on. 700 tankers are queuing outside the strait. Traffic through Hormuz has plunged 86%. This isn't just an oil story. This is a food story, a fuel story, a financial market story. And it's happening right now. Let's walk through the timeline. February 28, 2026, the United States and Israel conduct coordinated strikes on Iranian military and nuclear facilities. The operation is extensive. The stated objective, regime change. Within hours, Iran's Islamic Revolutionary Guard Corps issues a declaration. The Strait of Hormuz is now a military exclusion zone. All commercial vessels are warned to stay out. Radio messages go out to every ship in the region. Turn back or face consequences. And the ships listen. Not because Iran has physically blockaded the strait, but because the threat is enough. Tanker traffic collapses. Within 48 hours, the flow of oil through Hormuz drops by 86%. Over 700 vessels are now queued up on either side, waiting. Insurance companies are pulling coverage, shipping firms are suspending routes. Hapag-Lloyd and CMA CGM, two of the largest container carriers in the world, have already halted all transits through the Gulf. Iran doesn't need to sink ships. It doesn't need to lay mines across the entire strait. It just needs to create enough perceived risk that commercial operators won't take the chance. And it's working. From Iran's perspective, this move makes strategic sense. Brutal sense, but sense. If the goal of the strikes is regime change, if Tehran believes it is facing an existential threat, then holding the global economy hostage becomes a rational play. It's their ultimate leverage. Iran pumps about 4.7 million barrels of oil per day. That's 4.4% of global supply. They export most of it through Hormuz, so closing the strait hurts Iran too. But if the alternative is regime collapse, they're willing to take the hit, and they're betting the world isn't. Oil markets reacted immediately. Brent crude spiked. West Texas Intermediate followed. Futures traders are pricing in worst-case scenarios. Analysts are now projecting that if the closure lasts weeks, prices could hit 120. If it lasts months, 150 or higher. This is the spark. Now let's trace the fire. When oil prices spike, everything else follows. Let me walk you through the chain reaction step by step. First, energy costs hit you directly. Gasoline prices at the pump jump. If oil goes to $120 per barrel, you're looking at $5, maybe $6 a gallon in the U.S., higher in Europe. Much higher in import-dependent countries. Heating costs surge. Natural gas prices rise in tandem because LNG shipments through Hormuz are also disrupted. Your electricity bill goes up. Power plants that run on oil or gas pass the costs straight to consumers. Second, shipping and supply chains seize up. Major shipping companies have already suspended Gulf routes. That means longer alternative routes around Africa. Higher fuel costs, higher insurance premiums. Shipping costs explode. Anything that moves by sea, which is almost everything, gets more expensive. Electronics from Asia, clothing, cars, furniture. The cost of moving goods just doubled or tripled. Third, food prices spike. 1/3 of the world's fertilizer trade flows through Hormuz. Fertilizer is made from natural gas. Natural gas prices are surging. Fertilizer prices follow. Farmers pay more for inputs. Those costs get passed to food prices. Bread, meat, vegetables, everything climbs. And this is happening on top of disruptions from the Ukraine war, which already destabilized global grain markets. The world's food system is being hit from multiple directions simultaneously. Fourth, manufacturing slows or stops. Petrochemicals, plastics, industrial inputs, all of them depend on oil and gas feedstocks. Factories across Asia and Europe start cutting production or shutting down because inputs are too expensive or unavailable. Fifth, financial markets panic. Inflation expectations surge. Central banks face an impossible choice. Do they raise interest rates to fight inflation and crush economic growth? Or do they hold rates steady and let inflation run? stock markets sell off, particularly energy-intensive sectors, airlines, logistics, manufacturing. Emerging markets with heavy energy import dependence get crushed. Their currencies weaken. Their debt costs spike. Some face balance of payments crises. And sixth, the countries hit hardest are the ones that can depend most on Hormuz. China, India, Japan, and South Korea get over 80% of their oil and gas from the Gulf. India alone imports half its crude through the strait. India has already activated emergency contingency plans. Strategic reserves are being tapped, but those reserves by weeks, not months. China is in a similar position. The world's second largest economy is now facing a sudden massive energy shortage. This is the chain reaction. One closed waterway, millions of consequences, billions of people affected. And we've seen this pattern before. October 1973, the Arab oil embargo. OPEC producers, led by Saudi Arabia, cut oil exports to the United States and other Western nations for supporting Israel during the Yom Kippur War. Oil prices quadrupled, from about $3 a barrel to $12. Gas lines stretched for blocks. Rationing became necessary. The U.S. economy tipped into recession. Inflation accelerated. The ripple effects lasted for a decade. 1979. The Iranian Revolution. The Shah is overthrown. Iran's oil production collapses. Several million barrels per day, gone from global markets. Oil prices doubled, from around $15 to $39 per barrel. The result? Stagflation. High inflation combined with economic stagnation. Central banks raised interest rates aggressively. Recession followed. The 1980s, the tanker war. During the Iran-Iraq War, both sides attacked oil tankers in the Persian Gulf. Over 8 years, roughly 550 vessels were hit. The attacks disrupted shipping. Insurance costs skyrocketed. The U.S. Navy intervened with Operation Earnest Will, escorting reflagged Kuwaiti tankers through the Gulf. The lesson from each of these crises is the same. Every time the Gulf is disrupted, the world pays a massive price. And every time, the world forgets. Dependency on the same choke point returns. But today is different in important ways. The global economy is more interconnected now than it was in the 70s or 80s. Supply chains are leaner. Just-in-time manufacturing means there's less buffer. Strategic petroleum reserves exist, but they're lower relative to global demand than they were decades ago. The U.S. has tapped its reserves multiple times in recent years. They're not infinite. And this crisis is happening on top of existing disruptions from the Ukraine war. Global energy markets were already stressed. This is a second shock hitting a system that hasn't recovered from the first. The pattern is repeating, but the context makes it worse. So who benefits from this crisis, and who pays? The losers are clear. Oil importing nations take the biggest hit. Most of Asia, most of Europe. Countries that depend on energy imports to power their economies. Consumers everywhere lose. Higher fuel costs, higher food costs, higher costs for basically everything. Airlines lose. Fuel is their largest expense. Ticket prices spike. Routes get canceled. Travel becomes unaffordable for many. Shipping companies lose. Even though freight rates rise, the volatility and insurance costs crush margins. Emerging markets lose catastrophically. Countries with large energy import bills and dollar-denominated debt face currency crashes and economic collapse. Food-insecure nations lose. Countries that were already struggling with hunger now face fertilizer shortages and skyrocketing grain prices. Then there are the complicated cases. Iran itself. Closing Hormuz is a powerful weapon, but it's self-destructive. Iran exports its own crude through the strait. Shutting it down cuts off a major revenue source. They're betting that the pain they inflict on the world is greater than the pain they inflict on themselves, and that the world will blink first. China. Beijing is Tehran's biggest patron, but China needs the strait open. It depends on Gulf oil. This puts China in an awkward position, supporting Iran diplomatically while suffering economically. And then there are the short-term winners. U.S. shale producers. Domestic oil suddenly becomes far more valuable. Production ramps up. Profits surge. Canada, another non-Gulf oil exporter, benefits from higher prices. Russia. Despite its own conflicts and sanctions, Russia benefits from higher global energy prices. More revenue for oil and gas exports. Non-Gulf oil exporters in general. Anyone who can produce outside the Gulf region sees windfall profits. Gold and safe haven assets surge. Investors flee risk. Treasuries, gold, and the dollar all benefit as people seek safety. But here's the hidden story beneath all of this. This crisis isn't just about Iran, it's about concentration risk. The world built its entire energy architecture around a 2-mile-wide shipping lane in one of the most unstable regions on Earth. That was a choice, a series of choices made over decades. And now the bill is coming due. Let's zoom out. Every empire, every economic system that concentrates too much critical infrastructure in one vulnerable location eventually pays the price. The Romans built their grain supply around Egypt and North Africa, as when those regions were disrupted, Rome starved. The Spanish Empire concentrated its wealth flows through a few ports and treasure fleets. When those were attacked or disrupted, the empire's finances collapsed. The British Empire depended on control of the Suez Canal. When that control was challenged, the empire's decline accelerated. And today, the global economy depends on a 21-mile-wide strait between Iran and Oman. This is a stress test, and the system is failing it. What would real resilience look like? Diversified energy sources, not just different suppliers, but different types of energy. Renewables, nuclear, distributed generation that doesn't depend on long, vulnerable supply chains. Distributed supply chains, manufacturing closer to end markets, less dependency on single choke points. Strategic reserves that actually match the risks, not reserves that buy a few weeks, reserves that can absorb months-long disruptions. But building that resilience requires upfront costs, political will, long-term thinking. And historically, societies don't build resilience until after the crisis forces them to. So here we are. The Strait of Hormuz is closed, oil prices are spiking, supply chains are breaking, and the world is remembering once again that the most powerful forces in the global economy aren't armies or politicians. They're choke points, dependencies, and the fragile illusion that the system will always hold until it doesn't. If you want to understand how these patterns repeat, we break down the hidden systems that control empires, economies, and your wallet without the politics, without the hype, just the patterns that matter. Drop a comment. Do you think the strait will reopen peacefully, or are we heading into a prolonged crisis? What happens to your cost of living if oil stays above $100 for months? Thanks for watching. See you in the next one.